Palantir gets a super rally to close out the post-Thanksgiving Black Friday above $67 a share. And honestly, if you asked me in the beginning of 2024 that we would be where we are today, I definitely have a healthy amount of skepticism, but a pleasant surprise is always welcome. Now, this had me thinking about Palantir and where they are today and how they got here, which a lot of it is their turnaround and growth, of course, and overall expectations increasingly becoming more positive. But also, what can they do to keep this going and grow even faster fundamentally as a business? And for me, at least, it always comes back to that juicy cash pile that has continually increased quarter after quarter. And some may see this actually as a problem, but I'll let you be the judge of that yourselves, and you can let me know your thoughts on that below. Now, the big caveat though is we know there's still stock based compensation crunching this up, allowing them to operate with less cash expenditures. But the flip side of giving ownership to those delivering the company brings us to the chicken and the egg coming first and that problem around who's actually driving what. But let's put that aside for now and talk about that $4.5 billion elephant in the room, their cash and treasuries. Now, I think it's first important to acknowledge Palantir has achieved their 30% year-over-year growth again in Q3 of 2024. This has been without some huge expenditure to boost their business. We can see in their operating expenses the growth in their sales and marketing and R&D is mainly where they increase operating expenses with a slight growth in G&A, but nothing out of this world to make it look like they just threw a bunch of cash and drove that turnaround and growth. And this is continuing to maintain their margins and GAAP profitability, which got them into the S&P 500. So this discussion around cash may not even be necessary since they've already achieved this without dipping into their funds. So looking at their balance sheet first, we need to note the conversation and thought exercises over a longer period of time on speculating around Palantir using their cash pile. At least in the short term, I wouldn't expect any deviation from what they've already done, considering what I just talked about, them achieving growth without it, but also on their balance sheet here of $3.8 billion is sitting in marketable securities as treasuries and taking advantage of the recent high interest rate environment. The liquid cash is only around $770 million, and that's more than enough in liquidity for their current operations. And looking at their debt on the liabilities, current and non-current, they've got plenty of funds considering $700 million of this is current deferred revenue and customer deposits. So with that out of the way, setting the premise, what can we do with this cash of ours, and do these options even make sense? So first is something they've already been doing actually the past few quarters, buying back shares. Now, I'm not a fan of them ramping this up at all in their current state today. Anything they do right now is more symbolic, and they can keep those small buybacks just for the sake of doing it. But ramping this up doesn't make sense to me, where there's continued dilution anyways overshadowing this. When and if they reach a mature state of slowing growth and have phased out being a growth company, but still with a reliable, huge cash generating machine, then it makes sense to give a bigger piece of the pie back to shareholders over time when they retire shares at a good valuation relative to the fundamentals. Today, there's still a lot of growth and expectations priced in, so why utilize our cash for buying into that when I'd rather just have them use the cash to drive real growth in the numbers for future quarters? So buybacks is still an option, of course, and will probably continue in small amounts, but not a top choice at all for me. And I know my smart audience is already privy to this too and my feelings on the subject, but dividends right now is silly and not what I'd want to see in the near future at all. Plus, at least personally for my tax liabilities, I'd prefer buybacks over dividends anyways. Now, the first more interesting usage of cash is them investing in other companies, preferably customers and partners where they try to outperform the rate of return they're getting on treasuries. I'm still not a fan of this idea, and there are two big challenges here. First is the risk-free rate of return on treasuries is attractive. Even if you can beat that interest rate, what is the risk associated of underperforming, plus the headaches in managing this, and the possible optics around the whole thing? Obviously, if you choose wisely and things actually outperform, then we'll all be happy. But that's a risk for management to pull off, considering no one is forcing them to do this right now. Their backs are not in the corner, and it's not even necessary at this point in time since they are demonstrating returning growth. The second big challenge with this is we already saw this around with their SPAC investments a few years back. First, it looks like you're buying revenue, so moving cash into a company that in turn is just going to pay you back for services with the cash and or shares. And we know this turned ugly for those lofty valuations, deflating and many not even recovering. So I think it's just not worth it for the headache unless they become super selective and have really done a good job on working with these partners or customers and then have that much more confidence in them as an investment. Although you can argue too, you're just upping the risk for no reason, because if they are successful in the end, naturally the revenue should from these customers grow over time. So why double dip when you don't have to? Then, on a related note, is acquiring companies with this cash pile. Now, Palantir has built out their ecosystem on top of the ontology, and there's just a certain level of understanding and culture when you build something and all the other products off of this with the tribal knowledge that they've already established. And then going through a couple mergers myself as an employee, the challenges in integrating and applying synergies between the companies come together is a time intensive, and as well as the risk of falling things or just wasting resources is always around the corner. Now, I would actually say that this is interesting, though, in using their cash to acquire companies, not necessarily for their products, but the underlying intellectual property. Palantir continues to publish their own patents and many other tech companies too, and this is how moats are established. Even if you are attacking the same problem, your way of doing things getting patented might give you an edge that is yours to keep. And acquiring this to buff up your patent portfolio is something I would be interested in as a shareholder, as long as it's worth our while. And considering how careful management has been treading so far with the cash, I trust that they wouldn't waste this on some redundancies or inadequate intellectual property. I have no idea, of course, who would be a great target, but with $4.5 billion, they may be able to just get a small and up and coming company that is still private and in their radars. And who knows, they could be worthwhile to consume, and maybe that's an upcoming competitor that we can get rid of. But maybe you can argue Palantir's culture of creating working products could be necessary to supercharge whatever that company's been working on. Now, the most attractive usage of cash, in my opinion, is just plain investing in our own business directly. Now, sales is not what I'm talking about here, because they've gone down this road a couple times, and seems like this did not pan out. However, investing in AIP bootcamps seems to be working, because the AI market is still figuring itself out, and all the use cases associated. A technical salesperson could only do so much in educating prospective customers, whereas maybe a forward deployed engineer running a bootcamp with the customer themselves on their own data sees how they can really fully leverage the software. Then once they figured it out, the value of the product becomes that much more apparent, and leading to the big TCVs that Palantir's touted on their earnings presentations. So for sure, this path has bared fruit already, so why not double down this even more? And maybe they've already done this, but doesn't necessarily manifest into a huge cash expenditure, so even better. Now, the other ways we've seen them invest in themselves is R&D, and this has gone up, but isn't like a huge lump sum as I mentioned earlier. It could be more of the nature on actually creating new products and technology, where throwing cash doesn't have much marginal value, rather than just purely working on the problems themselves and just having that culture built around it. But I trust management to throw more resource when necessary if it's better for the longer term performance of the company, even if it does eat a little into the short term margins. So with all of these straightforward options, like I mentioned in the beginning, Palantir has demonstrated return and growth all while their cash grows. It can just be the nature of the beast that throwing money at things is just not necessary or worth it for them. And even if this fuels this, the money-making machine they are today is already working. I trust management to increase expenditures if it truly can supercharge growth. So my assumption here is that since they haven't, they don't think it's worth it. So in the meantime, with interest rates where they are today, I don't mind them continuing to accumulate their risk-free return from the treasuries, but if interest dramatically falls over time, I'd expect more urgency in finding a better way to utilize our cash. So I'm curious to know your thoughts on the growing cash pile below, and I'll see you in the next video.